could you just define 1031 exchanges, maybe the layman's terms way, right? And then give as much detail as you like.
Yeah, so the technical definition is a process by which a real estate investor can sell and reinvest their funds from investment properties and take up to 100% deferral of capital gains and depreciation recapture taxes. That's the technical definition, but I don't use it. Isn't that funny, right?
Yeah.
What I prefer to say is to somebody, it's like playing Monopoly for real, where you're literally moving your pieces around the board and you're making decisions that improve your portfolio in the process. And by the way, you're not having to pay the tax while you're doing that. You're not getting out of the tax per se. I mean, you could eventually with a stepped up basis, which we can talk about later. But in that specific movement in improving the portfolio, you're not having to be burdened by paying a tax, which cuts into your equity and your power and the real strength of the portfolio. So you can free to move pieces around and make it better for whatever that means to them. So we really spend time with clients starting there. I say, you're at A, you're trying to get to B. Tell me what B looks like for you. And then from that process, we're able to take them in directions, some cases where they already were going, other cases they didn't know they can go different directions. And that's really the power behind this, is understand that it's a tool and it's basically a section of the tax code that allows them to do this.
Yeah, I think what is great when we get on the phone together with clients, or you get on the phone with the client when I pass them along to you, is, you come from a place of, let's understand what your goals are and let's talk strategy on how we can achieve those goals, and
Right.
or let's just talk strategy around, is this really what you are looking for?
Exactly.
Right? And sometimes the client comes out of it saying, oh, well, I just learned a whole bunch. I'm actually trying to do X after talking to Drew, right?
Yeah.
Not what I initially had
Exactly.
in mind.
And as a handoff to a broker, it could save time, usually, right? It also is more efficient with time, so that if you're in a short period of time, if somebody finds out about an exchange last minute, their time is compressed, so they can't waste time. So, but they don't want to rush either, right? It's kind of that balance. So I found it to be very powerful for all the team to say, once we have a set plan that they're now buying into, now we're all focused on the same direction, full steam ahead. It's really powerful.
Yeah, that's great. And that's what you spend your day doing mostly, is coaching, consulting, however you want to define it, just strategizing, right? Handling that high level topic so then the foundation's right. We know what we want to do. Brokers on the same page, attorneys on the same page, accountants on the same page, clients on the same page. And then we can move forward and everyone can execute accordingly, right? So,
and it's interesting too. I'm not allowed to give tax or legal advice, right? You aren't either, right?
Yep.
But we're talking about tax issues. So the way we approach that is the team, as you just mentioned. Very powerful. We'll bring people up to speed. I can educate and point you, but I need your team, and you need your team to solidify that, right? And that's how it works very well. And usually CPAs are complimentary and appreciative of what we do, because they're brought in earlier than they sometimes normally would, or sometimes somebody doesn't have a CPA that now they're going to engage one, which is critical.
Yeah. So I like how you talk about playing Monopoly for real. And what I've heard you say in the past is, and I think this is how I visualize it best, is basically when you have Monopoly, when you're playing Monopoly, you have 4 houses on the board, right? And then the goal is basically you're going to trade all those 4 houses in for a hotel.
Right.
And that's basically the concept, right? You can do it. There's a few different ways you could do it, right? I think you've mentioned you could trade 1 for 1. You could trade 1 for 10, 10 for 1, right?
Yeah.
So you could do a lot of different things, but that's the general concept. And that's why you use that Monopoly term.
And it's funny, I watched a client do that back in like 06, 07 or something like that. Sold a property here in Boca and actually bought 7 in another area. And I'm like, whoa, it's like playing Monopoly for real. I was like, bingo. And the nice thing is you take something that somebody knows, and usually they're very emotional about it, right? They have a good experience with the game, plus or minus sometimes, right?
Yeah.
And then tied with something they don't know or they don't think they know. And then I'm like, it doesn't have to be 4-1. It could be 1-1. But just open your mind to say, okay, I'm trying to get here. Oh, I didn't know I could fill in the blank. And that's what I want them thinking early on as much as possible, because then they can move their houses around, or their commercial property, whatever it is, in a better position for them.
Yeah.
even in a really high market, actually. So it works very well no matter what market we're in.
We could talk a little bit about that too, just like why you would do it in that situation too. But the first thing that a lot of people ask me when they're super new to this or have no idea, if it's a deferred tax exchange, so if you're deferring taxes, why not just pay the taxes now, get that over with? Because in the future, who knows how much taxes are going to be on something. So why don't you elaborate on why you would even do this, given my question? Yeah.
Absolutely. It's a great question. And it's a question I would ask if I was a customer. I would say, wait a minute, you're just putting it off. My accountant says the tax rate might go up. And if it goes up, better pay it now. My question back to them is, why are you in real estate investing? It's quadruple compounding, all right? You're making money in appreciation. You're making money with depreciation. You get a tax credit every year. You're making money in cash flow. And you're also making money by time value of money. Because if you pay tax in today's dollars are worth more than future dollars because of inflation. I don't have to tell you what inflation is right now, right? So it actually benefits you if you cannot use today's dollars, repurpose them into another asset that's better producing for you, whatever that means. It could be more income. It could be easier management. It could be no management. It could be taking land and make it into something that produces income, or multiple streams because you don't want all your eggs in one basket, for say. So there's many different ways that it can go. And that's really the strength of it, not getting out of taxes. You can do that eventually, but that's not really the benefit. The benefit is to preserve what you have and build on it.
I think that's super powerful. And then finally, you can defer taxes unlimitedly and indefinitely, right?
Yes.
So elaborate on that a little bit, what I mean by that.
Right. So if you look at first paragraph of the section 1031 in the tax code, you can read it because you're a detailed guy. You definitely do that. Not everybody's going to read it. I read it long time ago. And basically what it talks about is usage of property, of real property, either used as a business or used to make money. Like they call it investment, using it to make money. And if you're using it for both of those usages and it's real property, you can exchange it for other things, right? The difference is that some people don't realize that could be go in a lot of different directions, right? So anyway, back to the question. Can you tell me the question again?
Deferring indefinitely.
Oh yeah. So
and what does that mean and why?
Sorry about that. Yeah. So the idea is that it's indefinite because you don't create a tax until you sell something. Any product or service that you have, as soon as you pay money for it, or you're receiving money for something you're selling, a tax is generated potentially, right? Unless you have a loss or something.
Touch the money, you pay the tax.
Exactly. That's one of my phrases. Touch the money, pay tax, right? Yeah. So if you don't touch it, you don't pay. So by doing an exchange, you're basically a deed swap. Okay, you're swapping one deed for another. That's why it works. It's been in the tax code 102 years at this point. So it's not a loophole. It's not some special program that is only for a certain group of people. It's for any taxpayer anywhere that's doing a process of swapping properties. Now, the key is you could swap properties today. You don't need us for that. If you had somebody you swapped a deed with, that let's say the two properties are saying they're worth the same amount and they have no encumbrances, no debts, we're just going to swap deeds with each other. You can do that. Maybe use an attorney, obviously you want to do that. But by swapping those deeds, you haven't created a taxable event. Therefore, there's nothing to tax you. Well, with the 1031, because there's money involved, you can sell to whoever and you can buy from whoever. That's where an intermediary comes in, and we'll go into it more later. But that intermediary holding the funds, sending the funds, keeps you from touching that money. Therefore, you have not touched any money to pay the tax on. And there's nothing at that point for them to calculate unless there's money that you touched. And it's unlimited because they don't have a limit on it because there isn't reason to have a limit on it.
You could do it as many times as you want.
Yeah.
Just continue to compound.
Indefinite means through your whole life. The only time you have to consider it is when you are selling something because that potentially causes a taxable event.
Yeah, that's powerful, right?
Yeah.
And I've heard stories of individuals who have done this indefinitely and deferred taxes even in death, they say.
Right.
And taxes in death.
What's interesting too is when you say you can do it multiple times, there is no limit, but you cannot use the property. Let me back up. So there's basically three fundamental usage of property. There could be more than that, but just three concepts. First is primary residence. Primary residence, 2 out of the last 5 years, people know that. Your accountant can confirm if it qualifies. But when you sell your primary residence, you get up to $250K of the gain exempted if you're single, up to $500K of the gain exempted if you're married. So people say, that's great, but what if I made more than that? Well, guess what? That's the limit. But it's also limited by that usage, right? Second usage is flipping properties. And there's nothing wrong with flipping properties. But when you flip a property, in a sense, you're treating it like inventory. No different than buying any asset, phones, desks, whatever, and selling it at a markup. Buying low, selling high. That's called income. It doesn't matter how long you've owned it. That's taxable. You cannot have a deferred tax on that. So the unique thing with 1031s is, yes, it's unlimited with dollars and also unlimited amount of times, but you don't want to be flipping properties into one either. So it goes back to when we have the conversation with them. All right, how have you used this property, let's say in the last 2 years? If it's investment, meaning I'm using it to make money, I'm renting it if it's rentable, or land, I'm holding on to it, right? Then you can quote unquote qualify it internally. You don't have to submit to the IRS to qualify it, but you're just saying that we believe that when we did this exchange, that this property qualified because we used it as an investment. Here's the activity. Here's the scheduling on our 1099 on our tax return, showing that we used it. Here's the rental income, and the property we bought we used the same way, and that kind of solidifies the two usages and allows that to happen. Now that you can do unlimited, you just don't want to flip properties into doing that. That's the only thing.
Yeah, very good point. Like flippers, this doesn't really work for you. We can talk a little bit more about how people's plans change and how you can then qualify. You initially were thinking about flipping it, and then now it turned into an investment property and a rental property, whatever. And now you're going to sell it. You can elaborate on that a little later. I want to step back real quick. So it's called the 1031 exchange because it's the 1031 section of the tax code, right?
Exactly.
Okay.
Yep.
Okay, cool. And then initially this was created, like you just said, 100 plus years ago, and it was created for some history for this is like it was created for farmers, right?
Well, that was one of the commonmost things. People would, let's say two farmers are swapping deeds because they want to use the property for different ways with the soil, whatever it was back then. It's not just farmers, but somebody wants to swap a deed with somebody. There's no taxable event. That's the core of what it is today. It's deed swapping. It's just not direct swap.
Exactly.
Usually.
Because there's money involved and there's different pricing.
But exactly. And that's why it's not a loophole. It's not like a something that would be another revenue generation for the IRS that they're letting go and stuff like that. It's like anything else. For example, you have an asset that goes down in value like a car. You get a credit. If real estate goes up, it's a gain, right? So it's a flow of how the asset and what the asset does more than a tax loophole. And that's the key for people to understand. It's not a loophole and it's not some special program for certain groups of people. It could be, we've done exchanges with property that's worth 100,000 and well over 30 million. So it doesn't really matter the size. It's just a matter of what the usage is. And by the way, how much tax you have to pay if you don't do it.
Sure.
And what your goals are. But we can cover that with the conversation.
Yeah, exactly. When we talk more strategy, and I have a handful of questions that I want to pick your brain on too.
Yeah.
Who can do this? You kind of just mentioned it, but also, and where can you do it?
Fantastic question. So if you remember, it's part of the United States tax code. It covers any United States taxpayer, not necessarily a citizen. So you have to be a taxpayer to take advantage of this. You can't take advantage of something in a system that you're not a part of.
Sure.
So if you're foreign national, obviously any taxpayer in the United States covered. If you're foreign national, you have to become a taxpayer and file paperwork with your CPA to let the IRS know that, yes, I'm going to start doing this, and here's the idea on this property we're selling. So regardless, you have to do that. Now, if you sell a property in the United States, you can replace with any other property in the United States. If you have properties outside the United States, you can do an exchange. As long as if you sell outside and you buy outside, you're good to go. So for example, let's say you sold a property in Singapore and you bought a property in Canada. No problem. Just couldn't go in or out of the United States with that. So it doesn't matter country to country as long as it's outside of. So if they have global income where they're going to be taxed from the United States and this will benefit them, excellent. The only caveat to that would be check with their CPA, both local and the international CPA, to make sure that it's the best fit. Because sometimes, believe it or not, paying the tax in the United States is a better decision than not paying it and having to pay a bigger tax in another country.